Hello, everybody, and thank you very much for joining us for this presentation with Rudyard Ekindi. Rudyard is a director in the Global Investment Solutions team at Lyxor Asset Management. So Rudyard is going to be giving us his thoughts on the topic of protected equities. What is its role in an insurer's portfolio? And what does optimal allocation look like? To remind you all, on the right hand side there is the live Q&A. Please do make sure you've got that drop down now so you can see on the on-air platform any questions that are coming in, and please do think of them from the word go. Rudyard will be leaving time for questions from our audience, please do put them across. Rudyard, good morning to you.
Good morning to you. Good morning to you too. Very nice to be here.
Thank you very much for joining us. So, Rudyard, I'll pass over to you now to kick off with your presentation when you are ready.
Very well. I'm much ready and very happy to be here. Very happy to have the opportunity in this kind of pandemic and confinement time to wear my first tie in many weeks. Do you mind putting the presentation up, and so I can start? Thank you very much. So next slide, please. So just a brief few words about Lyxor for those of you who have not come across us recently. So Lyxor is the one and only asset management division of Société Générale. It's been founded over 20 years ago. And we manage about 150 billion euros in terms of asset management. And broadly speaking, it's a 50-50 split between passive management and active management of many sorts. We focus solely on institutional investors, and the insurance market is indeed a very focused market for us. Next slide, please. The topic of today is the role of equity protection in an insurance portfolio, and as an illustration of that, because having been in this market for a long time, I noticed that there is still yet very little consensus about the role of equity protection and how it should be used within an insurance portfolio. And the illustration I use here in the context of insurance is, of course, that every car owner, every Porsche owner, so those who want to have high performance and high quality when they drive, the same way as insurance management individuals want and require high performance, they all insure their car, but we can clearly say that not all insurers have chosen to insure or to hedge their equity allocations, and we will try to see to have a little discussion today about why it is the case. Next slide, please. Clearly, hedging equity raises a number of questions and a number of challenges. It comes from various angles. What you can see is that it's actually not solely a decision of the equity manager or even of the investment team within the insurance company, be it an internal or delegated investment team. Actually, hedging equities bears a lot of considerations that relates to different stakeholders. Obviously, the investment division has a say, but also the risk division, but also the ALM division have a say, especially in a context where there are very stringent regulatory requirements when it comes to capital utilization. So even when the decision may be made to hedge equities, a lot of questions arise. How much does it cost? When to do it? Over the long run, Is it worth it? Because over the long run, we all expect the equities to deliver its equity risk premium. And so far, after every crisis comes sunshine. And so it's not an easy decision to make to hedge equities on a regular basis. Obviously, there are some tactical choices that are made at times. Last year, equity market went up by 30% in most developed countries. So the decision to hedge equity at the beginning of this year was probably a lot easier than it would have been 12 months before. Next slide, please. Here, what I'm trying to address is at a very, very high level, a rationale for hedging equities, I would say, from a strategic standpoint. In the conversation that we have today, I will really focus on the angle of strategic hedges as opposed to the tactical ones. Indeed, when there is a crisis such as the one that we have experienced in the first part of this year, there is a sense of urgency and there is a sense of the necessity for tactical decision. But what we can see, in fact, is that having strategic hedges in place, which means hedging the portfolio on a regular basis, can also be the solution, even in circumstances where we are surprised by shocks. So what this table here presents is a comparison between an unhedged equity portfolio, this here is European equities, and a hedged equity portfolio. So the top line is unhedged, the bottom line is hedged. And we are looking at two periods. The first period is since 2016 up to now, roughly speaking, up to now. And the second period is since 2007 up to now. What we have is that why those two periods? The first period that starts from 2016, actually, when I say now in this example, actually we ended in June of last year, so it doesn't include the COVID shock, which is relevant in what we're trying to say here. We are looking at 2016 until mid last year to see what happens in a scenario where, broadly speaking, equities continuously go up. Yet, when we're looking at what happened since 2007, we're looking at multiple equity cycles, which means periods where equities go up and periods where equities go down. Clearly, in a bull market, when equities continuously and regularly go up, it's very easy and very fair to say that the profitability, which means here is measured by the performance over the capital utilization, the solvency capital ratio. So the profitability of unhedged equities in a consistent bull market is meaningfully higher than the profitability of hedged equities. So here, 14% against 10%. It's make more sense in a bull market only to have unhedged equity over hedged equities. Now, when we turn to the longer period, when we have multiple equity cycle and multiple periods of rising markets and on market shocks, we can see that a long-only equity portfolio has a lower and meaningfully lower efficiency ratio than hedged equities. And in this case, we're talking about 24% for the hedged equities versus 19%. I'm rounding the numbers here for unhedged equities. So it's very important here to be able to have a consistent measure, especially for insurance company, because here we're talking about regulatory capital, a consistent measure of the efficiency of having hedged versus unhedged equity in the portfolio. The way this table should definitely not be read is by saying that an insurance portfolio should have hedge equities rather than unhedged equities, because what this table doesn't show is clearly the total contribution of those two equity portfolios to the whole balance sheet. And indeed, an insurance company has efficiency or profitability requirements, but it also has return and return objectives. And so in a number of cases, the first thing that the insurance company has to ask itself is that when they buy into equity, what is the total return and coupons that they want to generate from their equity allocation. So what we're saying here is that because overall they are more profitable, hedged equities have a role to play in an insurance portfolio, and because the insurance portfolio has to seek certain return targets overall, it's probably, and actually even certainly, a combination of equity unhedged and equity hedge that are necessary for the insurance company in their balance sheet when it comes to the profitability of the capital and when it comes to ALM, asset and liability management requirements. Next slide, please. Here, I wanted to have a look at this year, the main part of this year, so the first 9 months of the year, to look at certain metrics that help take into account a little more in a little more practical sense what it can mean to hedge a portfolio from a strategic standpoint. And as we recall from the earlier slides, there were a number of questions that were raised: the cost, the timing, etc., when it comes to hedging. So on the top left hand, we have a measure of volatility for equity markets. So this is the Vix Index. And as you will very well know, the volatility of equity markets are one of the main components of the pricing of equities. And as you can see, we started the year with volatility levels that were somewhere below 20%. At the peak of the COVID crisis, this volatility rose up close to or even above 80%. And we are now back to levels around 26, 27%, which are much more reasonable levels, but still levels that are meaningfully higher than long-term averages that we can consider to be around 20%. So the market environment is still more volatile, meaning more uncertain than the very long-term averages, but we are nowhere near the highs of February, March, and April. What does this chart mean? It simply means that at any given point in time during those last 9 months, it has been 2 times, 3 times, 4 times more expensive to try to hedge a portfolio than not to hedge it. So when one is purchasing protection and at what cost it is purchasing protection, can make a lot of difference if this protection can double in price depending on the moment at which it is purchased. So that's the thing number one here. On the right-hand side, the top right-hand side of this, we have the moneyness. So the moneyness here represents the level of protection that is achieved once it has been purchased. So in this chart, again, we're considering the first 9 months of the year. What we're looking at is a protection that has been bought prior to this year at the levels where it was targeting 80% protection for this particular portfolio. So the aim was to protect the portfolio at about 80%. So this is why we entered the year at this kind of level of moneyness for the puts for the protection. So what we can see here is that during the financial crisis, the COVID crisis, sorry, it wasn't a financial crisis, sorry about that. A protection that had been bought previously that represented 80% protection over the portfolio gain in value and gain in protection capacity and efficiency very, very, very significantly, to the point by which in March, those portfolios were protected over 100%. So in fact, the protection delivered even more than what it was originally anticipated, simply because the shock that we have experienced during the COVID crisis was of extreme magnitude and extreme speed. So what this means is that when you protect your portfolio on a regular basis, because what you can see here is that this protection was bought prior to the shock, not during the shock. When you decide to protect your portfolio on a regular basis, on a systematic basis, which means you buy your protection long in advance and long in anticipation of the shock, you can experience situations in which your protection delivers to your portfolio in excess of what it is anticipated. And this is a very important point, because usually when we talk to insurance companies, when we talk to risk managers, when we talk to ALM people, we clearly see that they don't take into account, they don't factor in the fact that the protection can actually not only be a source of protection and a source of cost, but also be a source of return, because it happens that the protection deliver over what was originally anticipated. And in that case, there is a possibility to make return, take profit on the protection itself. The bottom chart that we can see here, the bottom chart is the SCR, which is the capital value of the portfolio. What we can see here is that this SCR, solvency capital ratio, varies significantly over time. Obviously, this year, even more so because of the magnitude of the shocks that we have experienced. But it is a very important aspect of it that I want to point out and note here. At the beginning of the year, the solvency capital ratio of this portfolio was somewhere near 25%, which is the level that it has reached back after the rebound. But at the worst of the crisis, what we can see is that the capital ratio went as low as 5%. So if you look at the three charts together, what you see is that, in fact, at the moment when protection would have been very expensive to buy, at the moment when, in fact, this portfolio was very well protected since its moneyness was highest, the capital used by this portfolio was the lowest. And this is a very important factor, because strategic protection allows to make very, very, very significant capital hedge savings. This portfolio without protection would have a capital ratio of 39%, 40% plus. Thanks to protection, we start the year below 25, and at the worst of the crisis, we utilize even less, which is a fifth of the capital of the strategy. So which means very, very significant capital savings at that time. But the following point is even more important as far as we are concerned, because this is the time when, at the worst of the crisis, without this kind of strategic hedges, without a very rigorous approach to ALM, we may see some institutional investors who would have decided to cut protection, or or reduce their exposure to equities at that moment in time, just in terms of cutting the losses. Where in fact this chart here shows that thanks to at that particular moment, the capital, a lot of capital has been released, which means there is a lot of capital, additional capital that becomes available to redeploy. And this means that, in fact, this kind of strategy allows an insurance company to, at that moment, redeploy this capital into other things. At this moment, it could be credit, it could be private debt, it could be any other type of assets. It could be managing, using this capital to put in place certain other type of hedges, duration gap hedges, FX hedges. So this strategy means that at the time when everybody else without it is tight on capital, it has released capital to be able to redeploy elsewhere. So it's very, very important to take into consideration this kind of aspect and the kind of additional benefits of strategic hedges that strategic hedges enable. Next slide, please. On this slide, we want to purposefully address a particular point on cost of protection, because it's very often the very first question or the very first hesitation that insurance companies have when it comes to entering into strategic hedges. And what we were seeing here, again, we're all over the presentation, we have been using the same portfolio with the same hedging strategy, which is a strategy that we have implemented in one of our open-ended strategy. As well as dedicated mandates. And what you can see here is over the full year, I mean the first 9 months of the year, the cumulative benefit of the protection leg of this portfolio. And clearly, you can see that at the worst of the crisis, which was in March, this protection strategy delivered very, very, very strong performance, close to 13% of performance in the strategy. But the main thing that I wanted to show here was that what happens after the shock. Because there is a misconception that in the rebounds, the protection no longer delivers positive performance. And you can see that cumulatively, end of September, long after the shock, long after the rebound took place, the cumulative performance of the protection leg is still well above 2%. And the last point I want to make, so that I can leave you room for questions, is that not only that this protection has delivered cumulative positive performance, but all along the year, it has enabled to save more than half of the capital cost of an unhedged portfolio, which is an additional very significant benefit to the balance sheet. So thank you very much. In the interest of time, I will leave it here. And I know that there has already been a lot of information given to the audience, and I will leave it open to questions.
Fantastic, Rudyard. Thank you very much for your presentation there. So we had a question very early on, which I'll put to you first. How do you see returns on required capital for protected equities and how they differ between EU and US jurisdictions?
All right. So I'm not an expert on US jurisdiction, even though we have had requests for similar types of strategies from US clients. The main thing about EU is that EU, since the 1st of January 2016, has in fact established a common ground for measuring capital cost by enacting Solvency II regulation, which means that the cost of capital is measured, broadly speaking. Obviously, there are a number of details on a case-by-case basis, but on a large scale in Europe, the cost of capital is measured by the same tool for all insurance companies. And as far as I'm aware, this is not necessarily the situation in the US.
Okay, thank you. What about other hedging tools, volatility target strategies, for instance? What's your thoughts on those?
All right, very good question. Here we have been presenting what we believe is the most efficient way of hedging a portfolio, which is using streamlined puts with variable strikes on a dynamic basis, taking into account a number of the factors that were presented here. There are other ways to do this. Volatility targets is a mean by which one can set a cap on the volatility of the portfolio, let's say 20%, and to achieve that, it will disinvest the portfolio at times. So the first thing is that it means less exposure, less capture of the equity risk premium, and it means some savings because you're not buying an option, so you're not subject to implied volatility in derivative markets. So it means more savings in terms of cost of protection. But it also means that it's not very efficient for very extreme shocks, like the one we have had through COVID. And it's also not very efficient in terms of capturing a premium that exists in the derivative markets. So in fact, we do a bit of both. We combine some volatility control strategies and these sort of things.
Okay, we have just less than 2 minutes left, so probably time for a couple more questions if we're able to keep them short. What about other hedging tools, volatility target strategies, for instance?
So this one we just actually.
Sorry, I've just gone over that. What's the expected? Sorry, yes, I had it starred. What is the expected cost of insurance? Sorry about that, Rudyard.
Oh, all right. Thank you very much. So, expected cost of insurance. So, the cost that everyone sees is the tag on the premium of the put, clearly, and this one in, I would say, calm market conditions, it's about 3, 4, 5, 6%, depending on the underlying index, depending on the horizon of the option. It could be a little bit slight, it could be 6 or 7, 8%. So it's the norm. But in very agitated markets, it could be double, triple the cost. So that's the cost that everyone sees. What is a negative cost, which is a benefit, is clearly the fact that once you enter into this kind of protection, you release a lot of capital. So depending on how much capital costs for the insurance company, it could be very, very, actually, it is very, very beneficial. And it's netting on the premium cost, the fact that we are saving a lot of capital.
Great, fantastic. Thank you very much, Rudyard. Great timing there. So we've got 20 seconds left, so I'll conclude at this point. So to our attendees, we're now going to be moving into the virtual networking sessions. This is an opportunity for you to get to meet one another. So please do click on back to timeline and then go into the networking sessions next, and you'll be able to meet each other in the course of a number of short meetings.
Thank you very much, Noel.